Good afternoon, everyone. Thank you for taking your time on this Saturday long weekend and joining us to learn something new. It really appreciates, it really motivates me to see so many people joining on a Saturday to learn something new. Today we have with us Mr. Vikram Masand. Sorry, Vikram, I confused. He was my favorite critic, so I always confuse him with him. Vikram heads the learning and development for Edelweiss Mutual Fund. Before this, he was with reputed AMC like HSBC. He has done his graduation from MBA from London College. To tell about him, we have a lot of things. He has been addressing people from the past 20 years in this field. He has addressed more than 500 people webinars in meetings in a day. It's a lot about to tell about him. Vikram, you there?
Yeah, I'm here. If you can just allow me to share my camera and screen,
Yeah.
then I could.
Just a second, Vikram. Can you do it now? I think you can share the screen also. Perfect.
Yes. Yeah.
Oh, Vikram, you look much more handsome than your photograph.
Yes, I'm not as photogenic as you are, very honestly.
A lot of people who might have joined us might see me on with full of hair here on the head and face. So just a change. Life is full about change. Vikram, before we even start this session, a lot of my partners and clients are faced up with so many difficulties, many minor difficulties, but they are receiving it day in and day out. To jot it down, I'll put it in one or two, three liners. One is people as a partner and as a client, they are still in a dilemma ki, is SIP a real tool for sales to be in this mutual fund industry, or should always be running behind, putting up large sums of amount, or should SIP the key? Second is, in spite of selling 100 SIPs, 200 SIPs a month, they are facing with a peculiar problem of stoppage of SIPs. But the people who have started the SIP today, maybe after 6 months or 7 months, they're just stopping the SIP. Maybe we are not able to guide them properly how to address this issue. And third major issue is how long this SIP should continue. Okay, every partner, when he takes up an SIP, puts it 20 years, 15 years, just keeping on the edge. So how to make this client understand that whatever SIP is going to do, he should stick to that no matter what the market is, no matter what the period is. But whenever he puts in that SIP, whatever time he is going to select, the tenure he is going to select, should be there for a longer term. So can we address these issues in today's training?
Oh, yes, we will. So how long should an SIP be? We all talk of compounding. But how does compounding really work? When does it really kick in? We'll share that part during the course of our presentation. That's stoppage of SIP is another thing that we will talk. That people either stop, pause, do these things today because somewhere in their own mind they have also become fund managers. We read a lot, right? Information today is not that difficult to get, right? And reading today, I see, markets. I mean, if we leave the last two trading days of the market, everyone was talking about markets at all-time peak. This may not be the right time to enter. We should all wait and watch. Now that 2 days of correction has happened, now people will start saying that, see, markets are correcting. Now again, wait and watch, these are very typical of people, where people forget that we are not investing for today. We are investing for tomorrow.
True.
Right? So very simple. I mean, if you talk of SIPs or if you talk of any investments, I think bare minimum to minimum that people talk of it is at least 5-7 years. Correct. From now, right? SIP should ideally be more, but at least 5-7 years people talk of when they talk of investments, right? And I mean, if you look at today, 2024, and even if I go 5 years forward, 2029, how many people will I mean, I have asked this question to a lot of people, and you should ask this. I mean, I tell all people who ask me this thing, I tell them, ask your investors one simple question: 5 years ahead, where you think the market is going to be? Okay, so somebody tells me 1 lakh 10, somebody tells me 1 lakh 25, somebody tells me 1 lakh 50. Some are over optimistic, tell me 2 lakh. Okay, fine. I'm saying this is not my number, this is your number, right? You are saying this number. Okay, somebody is being very conservative, somebody is being very optimistic, whatever it is your number, right? So if you think markets are going to move ahead, please invest. You'll make money.
Correct.
Now, there are some people who are cynical, and I've had about 5, 7 people. I mean, I can count those number of people on my fingers. Who have said markets will either be at the same level or below. My candid response to them is, please don't invest.
Okay.
If you don't think you're going to make money, then don't invest. But that's a very small number. See, there are a lot of things that is happening across the country in terms of what we can all see. Consumption has gone up, and all of these things we all know, right? And quite clearly, if I want to take benefit of this, the best way for me to do this is by investing. And SIPs is the simplest and the easiest way for people to invest. So we'll have some slides on that also, in terms of when people pause and people continue, how that makes a difference. And your first question, I think, is a very, very interesting question. That is not there in my slides, but I'll address it for sure. A lot of people still are thinking, is SIP a sustainable business for them? Now, I can tell you, I was in Reliance Mutual Fund, and in 2010, 11, 12, we started going out little extra aggressive in comparison to competition, and telling them that you should do SIPs in terms of distribution partners. Okay. And it was a very hard sell from our side at that time. Hey, Karo, you should do SIPs. This is what the revenue is. Believe me, all those people who tried, who got into this, are those people who are today doing very well, because when you're talking of business, we should also remember one thing. You have to plan your business in a way that you're doing something for the future.
Correct.
And SIP is your best revenue meter for the future. Think of yourself. No, I mean, you in mutual fund business, you get your money on your asset.
True.
Over a period of time, your SIP assets will take care of a lot of your requirements. And classic example for this was during the COVID times, when our distribution partners, because when the market started moving up again, towards the end of 2020, and even when markets were correcting, their commission was coming through regularly, right? And that is all because those people who created a book were not stressed. So you do lump sum for your current, but you do SIPs for your future.
Future.
So that is how you should look at SIPs. You do, let's say, today SIP is very easy to sell, right? If I go and meet somebody and tell them, this is one XYZ scheme, do one SIP, I think the probability that he will do a 3,000, 5,000 SIP is very high.
Very high.
Right? So if you do 2 SIPs a day, or let's say 5 SIPs a week, believe me, at the end of 5 years, 10 years, your SIP book will be so strong that you may not actually need to go to work for your requirements.
Okay.
Right? So that's
True.
how strong it can become.
True.
So think of SIP as your future. So do lump sum. I'm not saying we should not focus on lump sum. Lump sum you do for today.
Correct.
But you do SIP for your future. 10 years, 15 years down the line, you will not have to worry about work, because you're getting monthly income through this hard work that you've done. Of course, you need to make them stay. You need to ensure that the book, book is maintained and all of these things. And we'll talk of some of those things during the course of our presentation also.
Okay.
So
You
let
can
me
share the
just
screen. Yeah.
share my screen now. Is my screen visible?
Yeah. Perfect.
Perfect. And to everyone else, a very, very good evening. And thank you very much for taking time out on this Saturday evening and joining with us. I mean, it's very encouraging to see about 120 plus participants on a Saturday evening, to listen to us. On a topic which, very honestly, for a lot of us, when I talk of SIPs, you will say, I know SIP, it is my bread and butter business. And I go ahead and keep on doing SIP. So, but what we've done very interestingly is, we have taken SIPs and connected it with various sports. We just had the Olympics, we had the Paralympics, Khelo India is a very, very big campaign being run by the central government to promote sports. And overall, if you see around you, there is a lot of interest in terms of sports from people. So people are going out and playing, either they are running a marathon, or they are playing football, or they are playing cricket, or they are playing, excuse me, or they, my apologies, excuse me. Or they are playing some sport or the other. I think somewhere this thrust towards fitness has gone up, and sports, we all know, has been a very big beneficiary in terms of this fitness wave that we are all rightfully moving towards. And what we've done is we've connected key attributes that you need for certain sports with investments in SIPs. And I want you to use this during your conversations with your investors, and also imbibe these as an investor yourself first, because we are also investors. So I'm a very big believer in practice what you preach, right? So first, if I am able to believe it, and then if I go out and do it, then my conviction level is very high. One very simple example I'll give you. There is this very classic question which I am sure at least 70 to 80% of our investors must be asking us, which is how you think of markets. What are you thinking of markets in the current times? Now, this is a very mundane question, and it's a trick question. Now, on our side, we will always say markets are good. None of us will ever go out and admit that markets are bad, even if we think. But we have to go ahead, so let's be very honest about it. So most of us have come with a very smart answer saying in the long term, markets are always good. In the short term, markets are volatile. And the investor starts thinking, I know this. So I'm saying this somewhere, and that when I say in the short term, or if I don't commit anything in the short term, or I use this long term, short term difference, the investor starts thinking that is the timing to enter the market right or wrong. So we should not get into this debate, short term, long term. We should say that, see, markets are doing their thing. We can't control what's happening in the market. We can control what we do, and that is invest and stay invested, because we are investing not for today, we are investing for future, like I said some time back, right? And if you in the future you want to create wealth from your money or from your savings, the only way to do that is through investing. And so you have to do what is best for your money, and you have to push them towards that. Markets will always remain as they are. They are not in my control. They are not in your control. What is in my control and your control is that we stay invested. When you go and talk to investors, like I was saying, 5-7 years is the bare minimum people say, but 5-7 years, if you think markets will be positive, then whether markets correct by 1,000 points, 2,000 points, and then starts moving up, or markets continue rallying on the tops, on the higher side, should not be a cause for worry. We have to do our job. Let markets do what their thing is. So today we'll talk of some very, very important traits which sports people have. They've developed over years, and these are same traits which we as investors need to develop if we want to become a good investor, a successful investor in terms of creating wealth for our investors. We have to tell them that these are some traits which you should inculcate. So that's what we will do. So the first one that I want to talk to you about is a marathon. A marathon is A half marathon is 21 kilometers. Right? And a 21-kilometer run is not something which you can do overnight. I can't decide today that tomorrow I'm going to run a half marathon and start running. Something will happen with my heart rate and I may collapse if I do this. I can walk maybe. I'm not saying I cannot walk. I mean, even that is going to be very difficult to walk 21 kilometers in a day. But maybe I can still walk 21 kilometers. I can't run. So if I want to do, if any one of us has ever tried doing this, or if you look at marathoners who are doing this, the one of the most important qualities that they develop is persistence. They show up. You know, they will they will continue to practice. They will go every day and slowly build their resistance, slowly build their capacity. You know, so first day they will run 3 kilometers, 4 kilometers. Next day, they'll continue like this for 3, 4 days, 5 days, then increase it a little more. And then slowly, once they reach 21, they will consistently persist on that level so that they are there. Similarly, when we are talking of investment also, consider it like a half marathon. What is long term? How long should I be? You write 20 years is what Kapil sir was selling. But I mean, how many investors of yours actually stay for 20 years? Believe me, if they will stay for 20 years, they will come back and tell you, why did I not do more? Look at this example that we have, a 10,000 rupee SIP. Okay, done. Now 7 years you do. Okay, amount invested is 8,40,000 rupees. I mean, and we are looking at this at Nifty values. Okay, very simple Nifty investments. So there's no ambiguity that this scheme, that scheme. There is no scheme. It's Nifty. Okay, and Nifty why? Because it's the most acceptable index. Very honestly, that's why we've chosen it. Okay, so your value is 13,64,000 rupees after 7 years. Now, when you see this 5 lakh plus increment in your portfolio, you love it. You like it. No? I mean, you started with 10. I mean, how much have I invested? I just invested 10,000 rupees every month. Right. And, over a period of 7 years, 8 lakh 40 becomes, 13. And this is when, the belief in SIP actually starts in this seventh year. Because if you look at it from start, let's say, first year 1,20,000 rupees invested, even the markets are great, you'll have about 130, 135. You'll say, okay, nothing great. 3 years down the line, 360 markets are doing well. You'll see about 450, 425. You'll say, wow, okay, good, things around this. 5 years, 6 lakhs, you'll start seeing about 8.5, 9, 9.5. You'll start thinking, something has happened. This has been a good decision for me. But when you stay 7 years, you see this value of 1364. Now your eyes open up as an investor. Boss, this has done well. And normally I would say this is when mistakes also start happening. Like in today's time, last 3, 4 months, there's this new term which I have been hearing in the market called profit booking. People say, I don't want to, I'm not redeeming my principal, but I've made money. Let me enjoy my money. So people are doing that. And I mean, we also start thinking, chalo, principal to is staying. So let them also remove some money and enjoy it. But see, now that is where the big mistakes from investors happen, because there's a difference between making money, and there's a difference in between making money and wealth creation. If you want your investors to create wealth, they have to be persistent in their journey. They have to show that discipline. Now look at this same thing, you continue investing. Chalo, this is a little smarter investor. He says, no, I don't want to remove. Let's continue. Okay, stays invested for another 7 years. Now total investment is 1680. Now this guy is seeing 52 lakhs. Then this, I mean, when you see 52 lakh rupees in your investment portfolio, you just don't know what's hit you. Because you never thought your SIPs will create that kind of thing. So 16 lakhs invested, you are at a 3 times plus. Right, a little over 3 times when you, I mean, or you see 52 lakhs in your portfolio, you say, wow, this was something which was unimaginable. Why did I not do more? Then you will say, yeah, I should have done 20,000. I would have got 1 crore. People start thinking like this. So now see, the magic starts, post 7 years. 7 years, you are happy. So you should tell them you're happy, now let magic kick in. So wait. And even better magic happens in the last 7 years. So people who are saying 20 years, no, if they actually stay for this 20-year journey, see, this investment is just 25 lakhs. And there's 1 crore 43 lakhs in the portfolio. Now, if I tell you today that you give me 10,000 rupees every month and stay invested for 21 years, and I will give you close to about 1.5 crores, you will not believe me. But this has happened. So compounding, we talk, right? That compounding is real. Now look at this, how compounding actually works. So 35 lakhs over a 7-year period has gone ahead and become more than 70 lakhs plus. So it has doubled it twice. That's how, 35 lakhs become 70 and then 70 became 140. So you added a crore odd rupees in just 7 years. Right? Your 52 lakhs becomes 143. You didn't double, you more than doubled in just 7 years. This wealth, 70% of this wealth has been created in the last 7 years. So you have to tell your investors, persist, stay invested. That is the only way to make money. You will withdraw, profit booking, fear of markets, whatever you call it. The minute you withdraw, you are not allowing compounding to happen. SIPs, so you do lump sum over a 5-year, 7-year, you see something, you remove money. I can understand. But an SIP is something which you should stick with. Because that is when you will see your real wealth getting created. And believe me, what is 10,000 rupees today for a lot of investors? Not much, right? People can put that kind of money. But if you put that kind of money and, this is what the outcome will be. For this, you need to be persistent. You need to be patient. You need to be staying invested. When I see 1364 out of 8.5 lakhs, I start thinking, wow, chalo, let me go for a holiday with my family. Let me remove this 5 lakh rupees from here. And you're back to 840. When I see 50 lakh rupees, I start thinking this was something which was fantastic. Now, though I can go ahead and travel the world, or I should redecorate my house. I needed 25, 30 lakh rupees to redecorate my house, 40 lakh rupees to redecorate. So money is available. Let me do it. I don't have to stress. Or I will go ahead and buy my big dream car that I wanted. Now, that's okay. I'm not saying that's not something which we should do. But, if you really want to enjoy this, then believe me, stay invested. That's the best way to do it. So the first thing that you should talk to them is you have to be persistent. You have to continue. You have to show up. You have to show up every installment. If you do it for 21 years, you will say thank you to me at the end of it. You'll say you are the best person whom I have met. So keep up with SIPs till the end. First one. So run like a marathon. Think like a marathon. Second is, athletics. Again, people, in athletics, endurance is a very, very crucial skill. Now, for example, markets fall, people panic and people stop, right? SIPs, right? And people think we are smart, no, I want to stop for some time. And, because I'm not getting confident in the markets. So people do this, so again, look at this example, I've taken two examples. One is during the COVID times and one is, uh, during the pandemic times, sorry, one is during the pandemic times and one is during the first big crisis that I think most of us would remember is the subprime 2008 crisis. Right. So over here, so for somebody who started, on 31st August 2007 and, stopped, discontinued SIPs in July of 2008 when markets were falling, just did 12 installments. saw negative returns, thought, "Arey, this was a mistake. I should have never entered," you know. But vis-a-vis somebody who stayed invested, just for a little more, just for 2 more years, uh, was able to generate very handsome positive returns. So a lot of times, the problem is, we analyze and think of the markets. We have our own analysis. And we start thinking, no, no, I am reading so much and there is something, more in the markets which will turn negative. So I stop. I tell you, no, no, I don't want to continue with this. I want to stop this SIP because I don't see my returns, and I see negative return. Negative returns in portfolios makes us as investors do a lot of irrational and stupid things. The problem is, in hindsight, this action seems irrational and stupid of stopping and discontinuing SIPs. Because if you will continue, that is the only time when you'll be in the money. See, what's the point? I removed this money at a loss, right? My 1,20,000 rupees, I removed at 1,04,000 rupees. My 1,70,000, I removed at 1,50,000. I start thinking I am smart because at least I have just made a small loss in terms of value. But it's still a loss. A loss is a loss. If I continue in this, if you've chosen schemes properly, and SIPs, usually you don't go wrong because you usually go with diversified schemes in most cases, right? Even if markets fluctuate, what will you do by removing this money? You are not going to invest it somewhere else because you had a bad experience. What you may do is you may either spend it or go to some traditional investments. Both are not going to be very, very smart in terms of returns. But if I've invested with a thought that I'm going to stay invested for 3 years, 5 years, 7 years, 10 years, a momentary volatile market should not be a cause for concern because I still have a journey to complete. So you have to tell your investors that you have to endure the pain. If you want the gain, endure the pain. This volatile markets is a painful period for you, me, for every investor. Nobody likes it. Nobody likes it when markets current consistently for a period of time. If I see a 1 day, 2 day, nobody minds it. But when it continues for 10 days, 15 days, even a 10 day, 15 day, I start worrying. And if this continues for about a couple of months, when markets end up in the red, my worry increases. And this increased worry makes me do something in terms of stopping all my investments, which in hindsight, I will regret. So tell them, endure this pain. We have a long journey. In this journey, this had to happen at some point in time or the other. Markets will be volatile. So it's happened now. It's good. Let it get over. Once it starts bouncing back, we will see how nicely we come back into money. So I, as an investor, have seen both these periods. And I'm sure many of us have done. But post that, when the markets turn positive is when I can say that, I felt vindicated that I stayed invested. I didn't take any irrational steps. So you have to teach them to endure. Endurance is a key skill in athletics, which is required. And same skill is required for investors. Tell them to be, to endure, whatever the markets throw at them. Because, so athletics, there's that short burst where they are running, a 100-meter sprint. But to do that at that level, they have to go through a lot of pain to gain that strength and speed. So tell them that you have to endure this if you want to make money. So second skill that you have to tell them is endurance. Similarly, cricket is something which I believe is, I don't even believe, I'm sure is a favorite with all of us. And if we talk of cricket, if you ask any cricket aficionado, who loved cricket. I mean, forget the last 5, 7 years when people have, the youngsters have joined this bandwagon. But somebody like me, somebody like Kapil Sharma who has a little more gray hair, perhaps we would say that Test cricket is real cricket. And that's where the fun is, because that's when everyone gets a chance to show their skill. The batsmen do their thing, the bowlers do their thing, the pitch does its own thing, and it's fun. I mean, I have kids, younger kids, and I tell them, there's a test match. They say, oh, it's so boring. And I say, I love it. This is what I love to see. Because, for a batsman in a test cricket, they know that what do they need? They need to focus. They need to know where their off stump is. They need to ensure that they stay in the line. Anything outside the off stump, they should leave. And they just need to stay. The bowler will deliver a loose ball. That is when they capitalize. For a bowler, the mindset is, I just need to keep on bowling on that off stump line, keep on nudging and teasing the batsman. Sometime or the other, he'll lose his patience and edge the ball. So it's a game that they play. And, what you need to do is you need to stay invested and stay focused that I am staying invested. If you're looking at SIPs, it is like test cricket. So last 2 years have been fantastic for the markets, right? Everyone's portfolio has been great. When you talk of returns, whether it's lump sum, whether it's SIPs, everyone will say, wow, I've made so much money. But when I'm talking about SIPs, SIPs are actually for the long term. Right, a 10,000 rupee per month in 2 years, it's 2,40,000 rupees. Even if I see 3 lakh rupees, let's say on the good side, I'll be happy that I made money. But it's the potential for this now. What will 3 lakhs do for me in comparison to what will a crore of rupees do? Right? In terms of mindset, a crore and 3 lakhs, there's a huge difference. 3 lakh rupees I'll remove today, spend it tomorrow, forget about it. But if I make 1 crore from some place, I'll never forget for my life. You have to think of SIPs as that. Look at this. I mean, when you're looking at this graph, it's very interesting. Over a rolling year period, when you look of 3 years, there are probabilities of you getting returns, negative returns, and your returns would be negative at a 70 odd percent. 5 years also you could get negative returns, but in a 10-year rolling return, you're never making a negative return. So you need consistency in your book, right? Consistency will only get delivered when you stay invested for a long period of time. And this is showing that you are never making a negative return. You have to build that. You have to have that focus that I am going to make my SIP, my book for the future. This is not for your today. You see 5 years, 10,000 rupees, 6 lakh rupees, start seeing 9, 10 lakh rupees. You start thinking, wow, 1 million has been created. You start thinking, chalo, let's do something. The potential from this SIP is not for 10 lakhs. You have to look at your SIPs that I want to make a crore and plus. But for doing that, you have to stay. You have to focus that it's okay. Let the markets do its thing. I will do my own thing. I will stay here. I'm not going to get out by the googlies that the markets are throwing at me at volatilities. I'm not going to take stupid steps and stop my SIPs, pause my SIPs. I'm just going to continue on my journey. Because I know my destination is not about this 10 lakh rupees. I want to get to that 1 crore or something around that. So stick on the wicket, like test cricket, they say you just have to stay on the wicket, runs will come. And for the bowler, they say you just have to keep on bowling that niggling line and length and wait for that one mistake which the batsman makes. And every batsman gets out at some point in time. Right? So, the bowler wins eventually in most matches. And that is why test matches is known as a bowler's match. But, when you talk of batting also, when a batsman stays and delivers, that's when it matters. So stick on your investments. Third thing that you have to do is think of it as a test match. Similarly, Chess again.
Sorry to cut you,
Yeah.
Vikram. Can you just go back to the slide? Some of the clients and partners are asking, can you just explain what is this rolling return actually mean?
So
Some.
rolling return, okay. So rolling return, and you talk about 10-year rolling return. What we've done is, we have used this period when you talk of 5 years rolling return or a 10-year rolling return. The way it works, or a 2-year rolling return is, let's say, so the period that we have taken is 2003 to 2023. Every day there is an investor who comes in, and every 3 years, what's his experience, and beyond is something which we are talking. So in a 10-year, we just have perhaps 2 times the investor gets in, at that point in time. If you look at, I mean, so in the end, so when you're talking about, or rather, you have one full 10-year when investors come in, because when it ends, at 2023, how many have stayed for 10 years will become important for me in this journey for a 10-year rolling return. Similarly, for a 5-year rolling return, how many have completed 5-year cycles is what I will see. And, similarly, for a 3-year, I will see how many have completed a 3-year cycle. So every time, so that's how a rolling return gets calculated. I hope that helps.
Thank you. Thank you.
Okay. Now, if you are following the news, then we are also world chess. Our youngsters also became won a lot of laurels in the world chess championship which just happened. And in chess, if any one of us have ever played chess, I used to love chess at one point in time. Read a lot of books about chess also. One thing which stuck with me was people used to say that if you're playing chess, don't just play a move. Think about your next 2 moves when you play a move. So if I move uh, my rook, then I have to think of all probable things that you will do. Then according to those probabilities, what I will do. Then again, what probabilities you will do, and then what I will do. So 2 moves ahead, I should think. Right? And that's how you win. So every move counts. Just don't play. For the sake of playing, just don't move something and move it on the other side. Right? Similarly, in SIP, every installment counts. People think they are smart. They want to pause SIPs. They don't want to invest, and, that is where, and when they get in the money, they start thinking, wow, I still made money. So for example, look at this, investors, so between 2007 and 2010, in a 3-year period, there's an investor A who skipped 15 months. So in a 36 months, didn't pay installments for 15 months. Still invested 210, got 270. Thought, wow, I did a smart thing. I've made money, by skipping these investments. I made money. But somebody who was consistent put 360, still got 490. So in percentage basis, also got more. So this whole thing about timing the market, looking at market, analyzing the markets, I think is one of the most futile exercises which people put their heads to. Our job is to stay invested in the market, and investments will only happen when I don't skip my investments. So you have to tell them that you stay invested. Don't worry about what markets are doing. This thing, there's this thing called rupee cost averaging, which we talk about as a feature of SIP, right? Now, what does this feature really do for investors? If I were to explain to you in a very simple way, when markets are falling, what happens is NAVs of mutual funds also falls if markets are falling. Logic. And if it's my SIP day, then my SIP amount is fixed, right? So because my SIP amount is fixed, I get more number of units because the NAV has come down. My number of units goes up. Yes. So when my number of units goes up, and markets will not always fall, right? Markets will turn. That's how markets work. These extra units that I get all get me capital gains, and they help me come out faster. So staying invested and investing every, is what is most important. So, think of it as chess, but luckily over here, I don't have to think about what you will do. I just have to stop worrying about what markets are doing. So there's only one thing which markets can do. They can either go up or they can go down. Either only two things, right? I have to just stay invested for my period. And that is when I will make money. So, don't make impulsive decisions. In the name of smartness, I will pause SIP, time SIPs. You started, you've done one of the major blocks, you moved on. You've started investing. That's a major block. You started. Good. Now stay. That's it. That's most important. That will you need. You don't need to time key. Okay, should I plan this? Should I do this? Not required. Just stay. And so every move counts. Every installment counts. Learn this from chess. Similarly, think of it like a game of hockey. Now, why hockey? Because hockey is another sport where we've done very well. And if you look at hockey, imagine you're playing hockey, but you don't have a goal post. Will you enjoy? No, you don't know where to hit the ball. You're just passing, for a little time you like it. After that, you'll start getting bored. You'll start saying, okay, I'm going. So hitting the goal is most important to win a hockey match. Similarly, in SIP also, knowing how much you want becomes your first thing, or having a goal is something which you should talk of, right? And if you know, then what you should do is, at least when you're closer to the goal, look at some rebalancing, or look at moving, from volatile to non-volatile investments. Now look at this investment, 2002 to 2008. Okay, this investor did his journey, I mean, if he would have removed in 2008, straight towards the end, he would have still made money. No, nothing wrong. I mean, but he would have not made as much he could. So he would have made less because he stayed invested only in that volatile asset. When you're closer to the goal, so this investor in April 2007 decided that, okay, we've done 80 to 90% of our wealth. Let's now protect it. And they moved. So then what they did was they still got much higher than what the markets did. So at this peak of 2007, October, this person would have perhaps regretted, and they would have called you in those 2-3 months, 5 months period and said, Arey, what did you do? You made me remove money over here. Look at where the markets have gone. We would have made so much more. This happens. But, then when markets start sliding down, in 2008, when this person actually needed money, October 2008, this person should have actually called you and said, thank you very much. You protected my wealth. Because that's what you've done. So as you reach closer to the goal, I mean, it's important that now you get defensive, because you have to ensure that, you are able to hit the goal. So that is why if you look at hockey, the focus is also on creating a very strong defense so that they can protect the goal. But our job is to hit the goal. And I will be happy only when I am able to enjoy my money. But for that, I need to know what will make me enjoy my money. That tangibility is very important. Right? I'm going to go and buy a big car. I'm going to go for a holiday. I'll do my child's education. I'll do my retirement, whatever it may be. That's your choice. But that tangibility becomes very, very important, because unless I know, then what will happen is I see some money. I start thinking what I should do. I'll do something. That struggle, to reach financial freedom, or to reach a wealthy thought in my, or a wealth account in my balance will never end, because I'm withdrawing. But now when I know, okay, I needed 10 lakh rupees in 5 years, I've got my 10 lakh rupees. Please remove it. It's fine. Your goal has come. Your goal has been achieved. So look at it as a game of hockey, you know. And like I was saying, rupee cost averaging is a very, very strong concept. We talk of compounding. Very few people enjoy compounding because they don't stay as long to really let that compounding impact come in. Uh, we don't even talk of rupee cost averaging to a lot of investors. Believe me, rupee cost averaging is a very, very strong hidden benefit that investors get. And you must, whenever markets fall, tell them it is good, make volatility your friend. You'll get more units because markets are not always going to fall. They will turn around. And when they turn around, these extra units that we were able to accumulate are the ones which will give me or give you, that extra capital gain. So make volatility your friend. Don't worry, let markets fall. This is a good time for us to accumulate. So let it happen. So rupee cost averaging is a very, very strong concept. You must talk about this. Don't forget compounding. Be persistent. Don't forget rupee cost averaging. Be consistent. Focus on your goal and ensure that through SIPs, first you, then your investors are able to create your wealth. This is what I had for all of us. Anyone having any queries, questions, I'll be more than happy to respond.
Yeah, actually, we have got a couple of questions. First of all, Vikram, thank you very much. Very, very thank you for this lovely presentation. Okay. One question that everybody is asking, more of I am getting this. So, what should be the planning of the goal? For example, how is the ideal goal setting done for, say, child's marriage, or how should we think about setting this goal?
So what I very honestly do, I do this very small exercise with people. I tell them, take a pen and paper. After 1 year, whenever you think you will require money for whatever thing, write it down. So somebody will say after 2 years, this is not a regular expense. Okay. So regular expense that I'm doing in the next 1 year, forget 1 year, because 1 year is too short a period for me to do anything. Right. But so after 1 year, somebody will say, I have to pay my child's fees. Okay, write it down. Somebody will say, everything. Some people get very detailed. Somebody will also say, I will go for a holiday after 2 years, and then after that, every year I will go. Okay, fine. Some people then look at major expenses. So then they will start saying, after 3 years, I want to buy a car. I will upgrade my car. After 5 years, I will redecorate my home. My children, future education, retirement, they start writing all of this. So that's the first step. So now these are your requirements. Right, wrong, I don't know, but you've written at least something there, right? So that's a good start. You start thinking like this. Then you start asking them, you also have current investments. Not everyone is starting rich directly with you. From your investments, you tell me what all can you take care of from this sheet. So they start crossing. I will do this. I will do this. Okay, fine. This is out. I don't even want to know where your investments are. You told me you have investment. Obviously, everyone has investments, right? Some in traditional SIPs, direct equities, wherever. So I will take care of these 3-4 things. Okay, this is also out. Then let's say 3-4-5 goals are still remaining. That is there. Now tell them to prioritize them, which is most important. 1, 2, 3, 4, 5. They will put it. And tell them now let's start thinking about how can we get there. So now they know, and then dig them by when you think this will happen. If I write my child's education now, will it happen in 3 years? Will it happen in 15 years? I need to tell you that. Then you know how much timeline I have, and then how much money you need. You can then start digging deep to get that goal more strong.
Sure.
But people don't even know what they're doing and why they need the money. It's a very good exercise for people to start thinking. Give them a pen and paper. Write your requirements. I'll help you to get there. But unless you tell me where you want, how much you want, how can I help you? So this helps.
Thank you for that. In continuation with that, Mr. Dinesh is asking, sir, in case if I have not set any goal, so what is the minimum time which I should do it for a SIP?
See, there's no minimum time, very honestly. Like I showed in the first slide of mine,
7, 14, 21.
you start loving it after 7 years, that this is something which is very good. but magic happens after that. So, and if you don't know, it's like, imagine you go on a holiday, but you don't know where you're going. Uh, you know, uh, so a goal, I would say, is something which is most important. If you don't know where you're going, you may enjoy the journey for a few days. After that, you'll yearn to come back home.
True. Then thank you for that. Mr. Pushpendra is asking, which is more beneficial, investing 1.2 lakh once as a lump sum or start 10,000 rupees SIP every month?
10,000 SIP every year. I mean, if you're talking of lump sum and 10K every month, so that means after 1 year also this 10K can come. So why you just want to settle at 1.2 lakhs? Or then why not take that 1.2 lakh and also the 10,000 rupees every month?
True. Okay. I couldn't understand. If investor capitalize gain by part with work, I don't know, for saving tax in long-term capital gain and
Okay, so
reinvest in
this is a more of a
gain.
taxation question,
Okay.
right? I mean, see, don't worry too much about taxation. I mean, very honestly, I'm not a big believer in planning too much in terms of tax. Very honestly. Tax happens when I have capital gains. Capital losses, you don't get taxed, right? And tax happens when I realize in our country, realized capital gains. So if I switch or do something, then that is different. But why do you need to switch? Unless you're closer to the goal, you stay invested, no? And don't worry too much about tax. I mean, eventually you will still have to pay tax whenever you get redeemed, right? So that's what's most important. You make money, that's what makes you happy.
Okay. One anonymous secondly. Hello, I was serious about investing in the SIP only at the age of 36. But since then, I have been regular in making SIP in the last 4 years, and that too quite aggressively, and started seeing good returns. I'm quite confident about monthly SIP and aiming for a very long term. But I'm still not quite confident about the lump sum investment due to the volatile market. Any suggestions on how the lump sum can be broken and invested in multiple intervals? What would be the ideal time in such a case? Or what would be the alternate option to move my investment from the FDs for better returns? Thank you.
So quite clearly, I mean, if you're looking at 5 years ahead, like I said, where do you see the markets 5 years ahead is a question which you should answer. And if you see the markets positive, your lump sum will also make money, right? In between, if it goes down and does anything, don't track your investments every day. That's what gives you the stress. So it's to invest and stay the course. That's when you'll make money. So that's how. Still not confident. There's a systematic transfer plan approach, STP approach, which people do. You can put it in liquid, put it in arbitrage schemes. From there, move it. Liquid, I think, is better in that sense. And move it from there into anywhere. That also works. Uh, so your choice. But I don't see why people should worry about if they have a longer horizon.
So, what would be the best alternative for FD as per you?
Best alternate for FD.
Hmm.
If I were to talk of FDs, then you should look at, PSU bonds, and debt schemes which are there. They are safe that way, so there are a lot of PSU SDL bonds that are there, through which schemes which have PSU and SDLs, and they are safe, for you to invest, and they are giving returns which are a little higher than FD. So I think that should be a better alternative.
I couldn't understand this question. What out three master stroke point to investor who has the ability to increase SIP, but he wish to increase because of not seriousness or hesitant? I couldn't understand what.
Even I don't understand this, sir.
Okay. Uh, Now, question which I don't know a little bit of. I would also want to add to this answer. What's
Yeah.
the best choice, direct or regular funds? Could you explain what would be the opportunity loss on account of high expense ratio because of the high distribution commission for regular funds? Can we able to identify? For this, Rajiv, sometimes somebody comes and asks me, should I go invest in direct funds? I will, you can invest, but where will you invest? So he says that I see YouTube, there are so many influencers, they suggested. So I give them a very different answer. It's like that you are having a headache. Okay. You open Google, you search for the symptoms and medicines, and you go to the medical shop and buy the medicine what you got on Google. So investing directly without an advisor is like that. Or else is the traditional way. If you have headache, go to the doctor, let him understand what's the problem and give you medicine, then go and buy and give it. Okay. The difference between both these two is indirectly you might be having any problem, but Google diagnosis that's a brain tumor directly. Okay, when you say it's a headache. But in reality, it would be just a lack of sleep, which is just a stress. So getting into advisor, going to advisor is actually understanding what is your requirement, what is your planning. So you always have the choice of direct or regular. There is no difference. 100% there is a whatever minute expenses of expense ratio. Otherwise, how the distributor will also survive. That's nothing else. Do you want to add anything into this?
So yeah, I mean, what you said is absolutely correct. I mean, see, I don't think there should be any debate, very honestly. If I'm an investor who has time and knowledge, then going direct makes sense. You tell me how many investors today actually understand the difference between a large cap, mid cap, small cap,
Hardly.
right? So if I don't understand basics, what am I doing? I'm going to some website or I'm going to some YouTube influencer channel and just going by hearsay. Point number one. Okay, what are the website? What are direct websites doing? They are evaluating only on one parameter called performance.
Performance.
Now, if you honestly ask me, this is the most flawed way of looking at it, primarily because this performance will never get replicated. It could get better or it could get worse, but it will never get replicated. Right? So that barometer by itself doesn't make sense. So if I have the time, knowledge, direct, okay, fine. But very honestly, for most investors, I think going through an advisor is the most apt thing. Because when should you enter, which is the right scheme, what is happening in the markets, all this matters. But again, for an advisor also, then what is important for us is we start delivering value. What's happening is for a lot of us, we are easily replaceable. Today you are servicing me. Tomorrow somebody else will service me and an apple to apple replacement is happening. Because you're not showing expertise, you're not showing value, you're just coming, talking scheme returns. That's it. Go beyond that. Go to personalized, customized approaches. Believe me, that is what will help. Talk to them what you want, how will you get there, how can I help you, I will curate a portfolio to you. You put the same schemes, but that customized approach really helps me that, you're doing something for me. And if you're doing something for me, I will pay you. And quite honestly, I don't see much of a debate in this because there are no free lunches. If I'm doing something for you, I need to get compensated. Now, either you do it or let somebody else do it, but somebody needs to compensate. Now, today is a Saturday. I'm sitting here talking to you because I get paid for it. Right? I will not want to
Correct.
do it for free. Let's be very honest.
Correct.
You're all, I mean, 120 of us of you all have given this time because you think that there will be something of value to you. Similarly, when you go to an investor, think what is the value that I'm going to give? If it's just plain transactional, then very honestly, you're going to lose the war at some point in time. Go beyond that basic stuff.
So, thank you. Mr. Dinesh is asking what should be the ideal portfolio allocation of debt and equity based on the age group?
Again, I don't think you should go via age. It's very personal, customized approach that you should work for. Don't go just by one parameter of age. It's very misleading. People who are above 60 should be in safe investments. I don't agree with this totally. People who are 30 should take aggressive bets. Again, I don't agree with that totally. It's very customized.
Okay. Mr. Gopinath is asking, I understand that SIP will give for long-term better returns even if market falls in the middle. But if we go for lump sum and the market starts to fall, what will be your advice?
Hold on. Don't remove your money.
One very tricky question. What is better, active fund or a passive fund?
Again, I think passive is gaining traction. You have to admit it, whether you like it or you don't like it. If you don't talk about passive funds to your investors, they are still knowing about it. So you should tell them that these are the different type of strategies, different indices, different smart beta strategies, factor investing that is happening in the market. And if they want to invest, promote it. I mean, I'm not so, but if you don't talk, they still know, because information is coming.
Correct.
Then they are thinking, why are you not telling?
True.
So you might, so passive is growing, investor interest is growing. So you have to admit to it and cater to investor interest. Active is still winning. I'm not saying that active is gone. You will still have more active than passive, but don't ignore passive is all that I'm saying. Active is something which is going to continue. You will go all out with that, but passive is something which is slowly now entering investor mindset.
Vikram, one question. This is my question. If if an investor, I meet an investor who's earning 1 lakh rupees a month with, say, around 40,000 rupees of liability, which is paying as loans. Okay, what should be his ideal investment in SIP, say around the age of 25, 30?
So if he's earning 1 lakh rupees a month, if he has 40,000 rupees as liabilities, and he should try and save at least 15 to 20% to start with. And initially from that 15 to 20%, so let's say that's between 15,000 to 20,000 rupees, he should try and save. And at least start with a 7.5 to 10,000 rupee of SIP to start with. I would say, little aggressive, but that discipline starts early then. And that will help to build up later on. That hard work or the stretch that he will do for 5 years now will ensure that these liabilities always remain within his control limit, because he's creating assets on the others.
Great, Raju. I think, would you like to invest 10 lakhs, which got it from previous bonds maturity? How can we categorize the amount in different sectors of mutual fund to minimize the risk?
So
Mr. Kiran has
invest, I
got
mean,
10
again,
lakhs.
it's very personalized, very honestly, we'll have to sit, understand what, and only then suggest the right, schemes.
Yeah, Kiran, I think actually we need to contact us to have a tea at least, if not breakfast, so we can actually guide you, seeing, understanding your age and everything. So there are a lot of parameters we can just advise. Uh, do you advise to move the funds to debt instruments while at close to our target, or allow the funds to continue in SIP? Example, I need
No,
50 for my kids'
if you're
fee.
close to your target, please move to debt schemes.
Okay. You just give an example. I need 50 lakh rupees for my kid fee and achieved before 2 years of the target time. Should I move it to debt to avoid potential impact from the volatility? He has achieved the target now, but he
If
still
you are,
requires 2 more years. He has to.
so please move to debt, please, immediately.
Okay. Since he achieved the target, you advise him to move. Now,
Yes, please.
think
You
about.
created your money. Why do you want to now? Why do you want to settle for 47, 48 just in case something happens in the market?
Okay. One of our partners is asking, sir, on phone pay, Google Pay, everywhere, wherever now it is active, they get a lot of recommendations about the funds, how to tackle this.
See, again, what are the parameters? It's just one parameter, performance. Does it really work? I don't think so. So in that sense, you'll have to go beyond that, and you have to show your expertise.
What is your view over Edelweiss Nifty 500 Momentum 50 Index Fund?
See, it's a good fund. Very honestly, it's a very smart way of choosing, looking at the top 50 stocks which are having momentum on their side and keeping them in your portfolio. And momentum has been a time-proven strategy over the last 15, 20 years. So I think it's a very smart beta fund that you should look at.
I think the last question is, any instance of mutual fund going to zero or insolvency?
No, never happened, very honestly. And there it cannot happen, very honestly, because till the time you investors are investing money, it cannot happen. I mean, unless money doesn't come or the market by itself becomes zero, it cannot happen.
Correct. Uh, I think we are done with the questions. Only SIP or diverse mix of investment would use advice. I don't know.
Again, it can't be so simple. We'll have to sit, understand, and then talk. I think all of you people should have a cup of tea with Kapil sir.
Always ready. Thank you, Vikram, for the lovely session. To all the attendees, we are planning more 4 to 5 sessions in the couple of next weeks. Okay, every time we are going to come up with some dynamic topic like this. And today, after listening to Vikram sir, I've become a fan. So I'll not leave him now. I'll try to get hold of him whenever possible.
Please, would love to do that whenever available.
Thank you, sir. Thank you for your time. Thank you, all the partners and clients who have attended. More than 148 people attended this session. Really, really thank you. I think still questions are pouring. Sir, which is the best index fund? And a lot of people are saying thank you.
Thank you very much. Thank you very much for this opportunity, Kapil sir, and everyone to take time out and join us. And look forward to continuing and taking this association forward. Thank you once again.
Thank you. Thank you, Vikram.
See you. Bye-bye.